Hi everyone, this is Doug Brennicky. In this installment, let's talk a little bit about an impound account and what that is. Now, an impound account also goes by the name of an escrow account, which is not to be confused with the escrow company that helps coordinate everything in a transaction. But the idea behind an impound account is that the lender will collect, in addition to the principal and interest payment for the repayment of the loan, they will collect towards your property tax bill when it comes due, your property insurance bill when it comes due, possibly mortgage insurance if it's required on the loan, and that would essentially be the things that could be included in an impound account for you. The reason why a lender may be interested in doing this, and at times it's absolutely required, is that it gives them more control over knowing that the borrower is setting aside money to pay those obligations when they come due. Now, we usually see that an impound account is required on conventional loans where the loan is above 80% of the value of the property, and they're also required on FHA and VA loans, by the way. The property taxes are calculated at the current property tax rate, which on a purchase is going to be determined by the purchase price in California. They're going to get a quote from the insurance agent as to the actual amount of the hazard insurance policy on the property. And if there's mortgage insurance involved, then they're going to get the exact quote from the mortgage insurance company. So the borrower, when they make their monthly payments, they're going to be making a payment that not only gives the principal and interest payment for the repayment of the loan, but also 1/12 of the property tax bill, 1/12 of the hazard insurance premium on the property, and the monthly mortgage installment. This is also a way that many borrowers, even when it's not required, feel more comfortable that they can pay it as they go along, so they don't end up inadvertently spending some money that they think they've been setting aside for taxes and insurance on when it comes due a couple times a year, and maybe spend it on something else. And when tax payment time comes around or their insurance comes due, they find out that the money that they thought they had set aside either wasn't sufficient or that they were tempted to use it for some other purpose and now they're short. It gives them a way to know that they're paying their monthly obligations every month and that somebody else is also kind of helping them make sure that they're on track for that. So that's the concept behind the impound account. At times it's required, many times it's voluntary, but it can be an effective tool for a borrower who wants just to make sure to write one check a month and have and be sure that all of their bills are going to be paid in a timely manner when they come due for property taxes and insurance. So I hope that helps you as you hear these different terms out in the marketplace to make sense of how everything fits together. Thank you, and we'll have another installment soon.